Good morning, everyone, and welcome to the third live evidence session of the Commission. Today, we're going to discuss the extremely important topic of the impact of the Trade and Cooperation Agreement on UK financial services, one of the largest sectors of the UK economy, and probably the one in which there remains the most to do in terms of defining how our new relationship with Europe will change things. I'd like to thank very much indeed the witnesses who are appearing today with us, William Wright, Emma Reynolds, Philip Wood and Nick Collier. And I'd like to start by asking each of them briefly to introduce themselves before we go to questions. William, would you like to start?
Good morning, everyone, and thank you very much for the invitation to join you today. I'm William Wright. I'm the founder and managing director of a think tank called New Financial. We focus on making the case for bigger and better capital markets in Europe. Before launching New Financial in 2014, I was a financial journalist and editor of financial news for 20 years.
Thank you. Emma.
Thank you, Peter, and thank you for having me this morning. My name's Emma Reynolds. I'm the Managing Director of Public Affairs Policy and Research at TheCityUK. TheCityUK is an industry body that represents the financial and related professional services industry, so a wider industry than the financial services industry, and we have over 140 members.
Thank you. Philip.
I'm Philip Wood. I was former head of the intelligence unit at the law firm Allen & Overy. I have taught courses at Oxford, Cambridge and Queen Mary University. I've lectured at about 60 universities. I've written about 20 books, including books on financial regulation. And I have 2 honours from the Queen, an Honorary Queen's Counsel and a CBE.
Thank you, Philip. Nick.
Good morning. I hope you can hear me. I'm joined on my mobile phone because I couldn't access from my iPad temporarily. So my name's Nick Collier. I am the representative of the City of London in Brussels, and normally, although I'm in London at the moment. As you know, the City of London represents the square mile, but we have a wider representational role for the sector, and I'm effectively their ambassador to the EU and the member states.
Thank you very much indeed, each of you. Let's go to the first question, which is a framing question from Layla Moran.
Thank you so much, Chair. Good morning, everyone. Thanks for joining us. And I'll admit I'm very much a layperson when it comes to these matters. So I wondered if you could help to explain to me and others. I mean, London's often described as a global financial services hub, but what does that actually mean? What are we selling? William, I wonder if I could come to you first.
It's an excellent question. That in this debate, we often assume a high level of knowledge, and we often use confusing competing terms. One way we think about it is to think of financial services in 5 different buckets in terms of the sectors within the industry, 3 different types of clients, and then in the context of this debate on Brexit, a very clear separation between domestic activity and international activity. So those 5 buckets by sector, we would say, were banking, insurance, investment, market infrastructure, so exchanges, stock exchanges, IT, trading platforms, and then the wider community that Emma mentioned, the advisors, the PR firms, the law firms, and so on. The 3 groups of clients, broadly, we would put into retail, individuals, you and me, commercial, smaller companies, and then the wholesale and institutional group, which is, I think, really the focus of the impact of Brexit. We're talking there about larger companies, international companies, governments and government agencies. And then this very clear separation between domestic and international. There is lots of domestic activity in the UK that is largely unaffected by Brexit. Our bank accounts, our pensions may be affected at the margin, but they're not going anywhere. What we're really focusing on, I think, in terms of the potential impact of Brexit on financial services is the international element, and it is in international banking and finance where the UK, where London really have this outsized market share in global activity relative to the size of the UK economy.
Thank you very much. Philip, do you have anything you'd like to add?
Yeah, I just add that the financial flows worldwide are about 100 times trade flows, so they're enormous, and the figures themselves are pretty colossal. If you take world GDP as 80 trillion, it's like 8 football fields. Now there is 8 football fields of 10 trillion each. Now, one of the markets in London, which London in fact dominates worldwide, is the foreign exchange market. And the size of that is 50 football fields. And the amount which goes through payment systems is 1,500 trillion, which is 150 football fields. So that gives you an impression of the amounts which are involved in these markets.
Thank you. Emma?
Just to add to that, Leila, that London and the UK, I mean, our international financial centre here is one of the world's most international, and arguably the most international, because although New York is our direct competitor, a bigger proportion of the business done in New York serves the US market than London serves the UK market. And I will come on to this on the second question, but we mustn't just talk about the city, despite the name of the organisation that I represent. This is about jobs across the country. There are huge clusters in big cities around the UK that have both financial services, banks and others set up, but also professional services. So, you know, if you think of the financial district in Manchester, PwC, even in the last year where we've had a very difficult time, have opened a huge new office in Manchester. Goldman Sachs recently announced that they were opening a new office in Birmingham. So please don't just think of financial services as the city.
Thank you very much. And Nick, is there anything that hasn't been covered yet from your perspective?
Well, I just to frame the conversation for what's to come. William's point is a really vital one, that we're talking about the wholesale sector, really. So let's park the retail sector. It's really important, as Emma said, it's really important outside London as well. So it's the way I often explain it, it is a form of a supply chain, and it's invisible. One of the City UK predecessors was called British Invisibles for that reason. And it's all about, as Philip was saying, about capital flow. So to a very specific example, you've got teams of people in London in capital markets helping a German company, raise money to do something, build a factory with a bond, and the people who buy that bond are probably Japanese pensioners. So it's an international supply chain, just like other supply chains, but it's pretty invisible. Or an Italian investor, part of their pension is invested in Brazil, let's say, and that's another supply chain. And of course, there's inward investment as well. So it's an ecosystem. I think that word will come up today, and it's largely regulated, which makes it very different to the other forms of services, or indeed other forms of supply chains. And that's an important element of what we're going to talk about today, because the question is, how do you regulate the supply chain? And just to bear those two examples in mind, you cannot regulate the entire supply chain in one place.
Well, so let's come on to the invisible supply chain, and specifically the Trading Corporation Agreement itself. And Nick, perhaps you can start on this one. What was in it? And also critically, what were the most important elements that are missing? And we know we've signed our memorandum of understanding. Is it going to help?
Yeah, was that to me?
That's to you, Nick. Yeah.
Yeah. So it's a pretty standard FTA, isn't it? The TCA, and FTAs generally don't cover financial services because, as I said just now, they're a regulated service, and generally speaking, the financial regulators don't want to be included in trade agreements. So I think we tend to say that it is disappointing that there wasn't more on financial services. It's disappointing on services generally, in fact, on both sides. But that's where we are. That reflects the red lines of both sides, and in particular, I think for financial services, it reflects the view of our regulators, and indeed EU regulators, that they don't want to be rule takers, if you like. They don't want to be dependent on others' rules or supervision where possible. So therefore the consequence of the of the TCA is that you lose that access that you had in the single market. Remember, that's pretty unique in the world, right? There's no other where in the world where you get cross-border access like you had inside the single market. Obviously that stops for retail, but it also stops for wholesale. So it's quite a radical change for our sector. Also slightly disappointing, I would say. Sorry.
So therefore, what are we hoping to achieve with the MOU?
Well, I think the MOU, again, is a fairly standard outcome of a TCA. There's a similar regulatory cooperation agreement in the EU-Japan agreement. There's a similar one in the UK-Japan agreement. And one would hope you would get to the same position with others. We might talk about that later. And a regulatory cooperation is a good thing. And I think it's really important that we have the MOU. It's a platform to build trust between the finance ministries and the regulators on both sides. It does reflect reality in a way that, as I just said, I don't think the TCA really does. And there's a strong nexus between the two. And by that, I mean there is ongoing co-supervision. So like it or not, we've got divorced, fairly radical divorce and with certain implications, but our regulators still have to co-supervise major financial institutions who are active both in the UK side and the EU side, and indeed quite often internationally too. So life goes on, if you like, both in terms of our supervisors having to work together, and life goes on in terms of those cross-border flows that we described earlier continue.
Okay, thank you. Emma, is there anything you'd like to add on that one?
Thanks. Yeah, thanks, Leila. Just to say that I just wanted to say all credit to the firms that we represent and indeed the government and regulators on both sides, really, because although there wasn't much in this deal for financial services, you didn't see a big cliff edge on the 31st of December. There was no big shock to the system. Things went very smoothly when markets opened in early January. So although there was a fundamental change in the relationship, firms, regulators and others had done so much preparation in advance, and basically our members thought that we wouldn't get much out of this deal. That was pretty clear early on. So we knew we were going to lose passporting pretty soon after the referendum, and therefore they had set up subsidiaries in EU member states, and they had made sure they'd applied for those licenses ahead of time, and regulators had worked with them to ensure that that happened too. So just to say, there was a pretty smooth transition early this year, and had that preparation not been done, that there could have been some shocks to the system, but there weren't. So just to say that that's part of it. There are, other than the MOU, there are other outstanding issues that we are pushing for. For example, we don't know what's the impact of the TCA is going to be on short-term business travel. The restrictions are now in, but obviously nobody's traveling, so that hasn't become apparent. So we are watching that one very carefully when that becomes more apparent. Data is a big issue, not just for financial services, but services generally. We are confident that that is going in the right direction, we hope. And then the Lugano Convention, which is about the jurisdiction across borders, that doesn't look like it's going in the right direction. So there are other issues beyond just the MOU. The MOU is important, as Nick said, because it's important that both sides, both the Treasury on our side and DG FISMA, so the financial services part of the Commission, stay close together in terms of how they are going to change regulation. We're going to come on to this. They haven't granted many equivalences to the UK, only 2. So therefore there is going to be change on both sides. That's inevitable. And it's important that in that dialogue, they get ahead, hopefully, of those changes so that they can continue to build trust and cooperation. So we think the MOU and when the dialogue starts is incredibly important. And so will be the consultation with industry too, which we're discussing with the Treasury.
Emma, thank you very much. Leila, I think we must, in the interest of time,
there's one quick, really important question perhaps to ask William, and then if it's all right, Chair, which is simply, was the financial services sector let down by the government in negotiations?
The multi-trillion euro question. I don't want to sound heretical on this, but my answer would be no. There was lots of talk of the golden goose and the city being sold down the river or thrown under a bus. As Nick said, once you make political decisions in late 2016, on red lines about no single market, no ECJ, no freedom of movement, the outcome for the city becomes mechanical. So I don't think the outcome may not be what many people in the city wanted, but between making those, it's a direct consequence of the political decisions taken 5 years ago.
Thank you.
Thank you very much. Thank you. Could I now move to the second question? Tamara Sinsick.
Hi, thank you. Like Layla, I am not from the financial services, but what I do see in the questions that I've been asked to submit and ask you are parallels with the industry that I come from, which is the fashion industry, that also is looking at its global presence. It's the largest of the creative industries and also has built up a global reputation as a leader in the UK. So the first question I'd like to ask are, and this is first to Emma, is what are the benefits to the country of being a leading financial services player?
Thanks, Tamara. Lovely to meet you, albeit virtually. So there are both direct and indirect benefits, but I just wanted to underline again that financial services underpins this wider ecosystem that Nick referred to earlier of professional services that support financial services. So whether it's the accountants, the advisors, the other professional law firms, other professional services firms, and that ecosystem is pretty unique and unrivaled actually. And as a whole, it employs 2.3 million people, and 2/3 of whom are outside London. So again, this is relevant to the rest of the country, not just to London or the city. The industry is the biggest taxpayer, and last year paid 75.6 billion in tax, which is around the 2/3 of the government's education budget. And it's the biggest exporting industry, bar none, because it generates a trade surplus, which is greater than all other net exporting exporting industries in the UK, and half of those exports come from outside London. So, and then for individuals, obviously the financial services sector has benefits too, because it allows people to buy a home, say for the future, plan for retirement, insure their belongings. All of the people on this call will be using those services, I'm sure. But also crucially for businesses, it's an engine for growth because it allows them to access finance either through traditional loans or other means, and allows them to raise money on capital markets. So we believe it's a national asset, and we believe that in working in partnership with government and regulators, it's critical that we ensure the future continued success of our industry.
Thanks, Emma. So in my industry, on average, a half to 1/3 of workers, and this is across the entirety of the sector, which is obviously from creative to manufacturing, are EU, or pre-Brexit were EU passport holders. What's the demographic of that with your sector?
I don't have the stats at hand, but I could certainly send them to you afterwards. There are lots of Europeans working in financial services in the UK, but I don't have the figures for you.
Okay, thank you. Just because for the
William might have them at his fingertips.
Yeah, thank you. And I'm drawing in Philip, and perhaps if you know about that. It's just because what I'm hearing from my sector is that long term they're worried that some of the jobs which relate to customer facing opportunities are going to be less attractive to people with all the multilingual capacity that they have. So customer services, for instance, will be relocated for the fashion industry out of the UK. And I wonder if it's the same for the financial services. But thank you, Emma. If you could pick up on these questions, please, Philip. What are the benefits? I'll repeat it again. What are the benefits to the country of being a leader financial services player? Philip, you're on mute, which is the classic thing we all say on Zoom. Thank you, Philip.
As Emma said, it's basically jobs, tax, GDP and material prosperity and status, But I think looking at the thing in terms of the wider world, one of the purposes of capital or finance or credit or whatever you like to call it, is firstly to alleviate poverty, and secondly, to redistribute wealth, and thirdly, to provide for growth, to enable growth. Now, of course, I realize that a lot of the money is wasted, but then, a lot of people waste their lives, and that's not unreasonable.
Brilliant. Oh, that's quite a philosophical answer to the question. Do you have any stats at all on the kind of ethnic makeup of the people within the industry? How many come from the EU?
I don't have stats, but I certainly found that, you know, in the work I do in my firm, there's hardly an Englishman in the place, to be honest.
Okay.
And frankly, in the city, I think one of the great glories of the place, and something which I absolutely love, is people are from all over the world. So, you know, I think it's a great boon and something we really want to try and keep.
Thank you. So, I mean, that leads on to the second question, which I think we're starting with you on that. And if actually, before I go to that, does anyone, William or I think it's Nick, would you like to come in on those points before we go over to the second part of the question?
Tamara, just very briefly on the stats on EU employees. There is a jobs board for the city called eFinancial Careers, and every year they publish their analysis, anonymized analysis of the nationality of people in their database for city jobs. Their latest figure, I think, is around 15% were pre-Brexit EU. That to me sounds a little bit low if we're talking about the wholesale international end of the city. I would put it at more like 20%, and in some sectors even higher than that.
Thank you. I think the reason I've asked that is because it actually draws on the second part of the question in terms of attraction and what builds status, and certainly being a cosmopolitan city, as you've said, supports that. Nick, do you want to come in before I go to the second part of the question at all?
Well, just two separate points, really. One is there is an advantage to the UK economy of having the international sort of wholesale markets here, which is it gives you more diversity, and I think we would argue more resilience in your economic system. And I mean, not the purpose of today's discussion, but as William knows, William does a lot of work on this. One of the problems many EU member states have is that they don't have a capital market system. So your company, you know, maybe your companies in your sector tomorrow, they're very dependent just on their local bank for financing. So the fact you've got these international firms who maybe are primarily servicing big international companies, actually there is a capital market in the UK that they can tap into. So it makes our financial system more competitive, and that's a point I'll come back to later on. It's really important and more resilient. And my second point, which I guess leads on to what you're going to ask about now, on your example of staff. By the way, I think William's right. I think in wholesale firms it's often higher. I've come across firms where, you know, it's 30% if you like at EU. But the sales function, you talked about sales functions tomorrow. You can't do that anymore, right? Because as I said at the beginning, this is a regulated activity. So the German-speaking salesperson for a big investment bank X that was sitting probably most of the time actually on a plane traveling around seeing German clients, but technically based in London, will now be based probably in Frankfurt because that's a regulated activity. Right. So you lose some of that, some of your EU staff who would have been the sales force, not all of them, but of course they've had to go.
Thank you. That's really, really valuable information. Thank you very much. Philip, you're leading on the second part of the question, which is what does the UK need in order to remain a strong financial services exporter? What attracts activity to the UK, and where are our main competitors?
Thank you very much, Tamara. That really is a pretty central question, a really good question. I think my answer to this, and I'll sort of deal with it in a slightly different order from the way you put it, is to look at what the city's got. You know? And I think it needs a little bit of background. Now, the first piece of background is that there are about 320 jurisdictions in the world, which are sort of legal territories. You know? And out of those 320, 40% of them are based on English law. And so the preponderance of the English ideology is very important in the world, as it is with other European countries such as France and Germany. About 85% of the world's jurisdictions are based on a Western legal system. Now, English law has another characteristic, which is very important for what we're talking about and for financial markets, and that is it is an international public utility. It is one of the two most used governing laws for all of the big contracts, syndicated credits, bond issues, derivatives, and long-term supply agreements. Contracts have to have a governing law, and English law is chosen. Anecdotally, between New York and English law, they have about 80% of that market. So that's an enormous thing which this country has, and an enormous sense is very important to the general status of the country. And the third thing about the legal system, which is the real underpinnings of any market, you're operating within a system of laws, of private law, not just regulatory law, is that the legal system, for all sorts of funny historical reasons to do with Adam Smith in the 19th century, and God knows what else, is very suited. It's suited to financial business. And one of the reasons for that is got a very high degree of contract predictability. That is, the courts don't decide what they think is fair. They tend to leave it to the parties to negotiate their own contracts. I'm talking about business to business contracts here, not consumers. And the second thing is it's got some very, very important, systemically important risk-reducing features which are embedded in the legal system. As a technical matter tomorrow, this is only for people who are in the business. There happen to be set-off and netting, the presence of the trust and custodianship and collateral. Now, those result in a quite fantastic reduction of the immense risk which I've been talking about. Now, those things are not available in any of the EU civil legal systems. Again, for historical reasons, they're not wrong. It's not right or wrong. It's not good or bad. It's a question of how your legal system is adapted to a particular business. And English law has this quite incredible ideology, which fortuitously tends to favor the free workings of financial business. It reduces risks, basically, and it's very conducive to the forwarding the business. Now, so that's one thing which is really important, the legal system, which has taken centuries, to build it up. The second thing is that this country has the language. Now, I don't want to make a big jingoistic point about that, but I would mention that, ironically, the language combines the streams of the Latin and Germanic traditions in Europe, and therefore is, ironically, the most European of all the languages. And it happens to be the lingua franca of business. I'm not claiming, I think the Americans who did that, not us. And also, ironically, the language was a result of two colonial conquests of Britain with the Anglo-Saxons and then the Normans. So they did us a favor, to be honest. And then the next thing, so we have a legal system, we have the language. Third, we have an immense amount of goodwill. And again, I don't want to get sort of patriotic and jingoistic about this either, but the fact of the matter is that if you look at the rule of law and the impartiality, due process, regulatory proportionality, experience and expertise and all of this thing, familiarity of the legal system around the world and how we operate, I would think that, and if you combine that with the general economic power and defense power and the history of this country, in terms of our overall international clout, which is very important for markets, we're probably number 3 in the world, after the United States and China. So those are 3 things: legal system, language, goodwill. And then there are all the other things, like it's a lot of liquidity in the markets, lots of experience. We've got a good infrastructure. We've got a good size in terms of population. We were in the right time zone. There are good schools in London. The transport systems, worries a lot of people, but there's lots of culture and all of those things. But I think that the foundation of these is on those things I've just mentioned. Now, there's only one other point I'd mention tomorrow, if I may, and that is that the world, they say, is becoming financialized, and people think it's a very bad thing. But what's really happening is that as GDP goes up, that really is, it means that all the boats are going to rise at the same time. And we can expect, and I certainly hope, but who knows, but I certainly expect that world GDP will go up, which means there'll be lots more business, and it'll be very important that this business is properly regulated and looked after by legal systems, because the laws are very important in that respect. So, so I think all this money is not going to go under the mattress, it's going to go into financial markets. So this money represents the work and labor of the people. And not only is it a means of exchange, but it's also connects us with our futures through our pensions, which also is a financial service. And in addition, it connects us with other nations because we have to trade and we need money to do that. Now, some people think money is the work of Dracula, but I don't. I think it was a very, very good idea.
On that note, Philip, I think in the interest of time, it's a fascinating.
Well, I would love a lecture, Philip. That was really interesting,
Yeah.
and I loved bringing language into it, because I'm an English graduate, and I had to learn Old English, which has no Latinate language in it, and I'm quite glad we're not speaking like a scene from Beowulf. Have we got time to ask anyone else, Chair, or do we have to move on?
Okay. I'm afraid, just to remind everyone, if we need to keep to 7 or 8 minutes per question. So thank you very much for that. It was
perhaps if the other speakers have got points they could put into the chat and we could pick them up afterward, then that would be really helpful. And thank you very much. Thank you, Philip. Take care. Bye.
I'm now going to ask Caroline Lucas, please.
Thank you, Chair. And this probably is quite a quick question, because I suspect the answer might be we don't yet know, but it's a question for Nick. And it's about the cost of Brexit fragmentation on individual customers. And I'm thinking in particular, for example, of UK citizens living abroad, losing access to bank accounts, or small businesses finding it harder to access finance. Have we seen any of that yet? And if so, are there measures that could be put in place to try to reduce any negative impact?
Well, I think, Caroline, you're right. The answer is we don't know the costs or the numbers. I mean, the Banking Association might know, and we can check with them if you like offline, or you can do that. I mean, it is true that I think some people are not anticipated, that cliff edge effect, on January the 4th, that you lose because it's regulated activity, and so it had to stop. And the answer is, well, you then have to take out obviously a local service. So we don't know the answer, I think, Caroline, on the citizens, indeed the other way around, I guess, EU citizens potentially as well in the UK. So we don't know. And nor do we really know, by the way, the impact even on the wholesale markets yet. I know you may come on to that, but we don't know.
Thank you. It was very short. Does anyone else have any light to shed on this, or is it a general feeling that we just can't even anticipate what the answer might be?
I think, Caroline, I agree completely with Nick. There's plenty of anecdotal evidence that UK citizens living in the EU have lost access to services previously provided by UK banks, and vice versa. I'm not aware of any data that is being collected by individual firms or by trade associations at a national or EU level to pull that all together.
Okay, thank you, Chair. Hopefully I can use my extra minutes at a future meeting. I can trade them off.
Yeah, we'll bank those minutes for your next one, Caroline. Jeff, can I turn to you, please? Jeff, I think you're muted. Jeff? For some reason, we can't hear you, Jeff. No. You're completely silent. Jeff, while you sort that out, I think, Aidan, would you like to put the question for Jeff?
Yes, certainly. If we can bring it up now.
Or I can if you haven't got it.
No, I've got it. So I'm going to start with Nick on this, and then to Emma to add. So how does London compare with other cities as a centre for fintech, sustainable finance, and to what extent will it be important to influence global regulations? I do have a follow-up on this as well.
So I think that's an important question, because I think digitization and use of fintech, and also supporting the move to net zero economy, are two kind of massive secular drivers for our sector. Right, we're a services sector in the middle of digital transformation, so it's important that the UK stays ahead of the pack on that and stays competitive. And the same, I think, on sustainable finance. And then that reinforces all the points that Philip so eloquently made about why London and the UK are centre for this activity. And I think the signs so far are very positive. I mean, obviously, in a way, California and the US are probably the leading centers for investment in innovative technology. But I think the UK it comes a close second. I think over $4 billion, I think, is the stat we use for last year alone invested in fintech in the UK. So it is becoming, a cluster in fintech, just like it is a cluster, as we've discussed, in wholesale financial markets. And that's partly about talent. And as we were discussing generally, that's important that we stay open to talent. It's partly about the quality of our regulation and the quality of our supervision. That was the one point I would have added to Philip's remarks, by the way, about why the UK is such leaders. We have well-regarded, very experienced supervisors, regulators. And if you ask firms, including fintech firms, as well as big banks, what's one of the most important things to them in financial regulations is the quality of supervision. And that gives us a huge advantage, by the way, over most EU centres, for being a little bit narrow-minded about it, because they don't have the experience of regulating and supervising wholesale financial markets. And I think we're getting a head start in fintech as well. And I would just mention, if committee members haven't seen it, the Collier report that we were the co-secretariat of, reported to the Treasury on fintech recently. Treasury endorsed, I think, most of the recommendations. Is an excellent report. Talks a lot about the need to get more investment in fintech, to get more scale. That reflects in turn the openness of the UK to external investment in the UK, being extremely open, getting scale. The skills and the regulatory environment is really, really important. And I would also endorse the work that Hugh Fanstinas and Mark Carney did in the Bank of England a couple of years ago in a report called The Future of Finance, which also, I think, was a very honest assessment of the way that our own regulatory environment and our own supervisors need to adopt new technology, including the buzz phrases that you may not have heard, like reg tech or sup tech, supervisory technology, and indeed increasingly on sustainable finance, probably green tech, right? The world is run on data, and as is our sector. And so the way that you can reflect that in your supervisory tools as well as in your financial products is really, really important. On sustainable finance, the UK, obviously helped by our leadership in G7 this year, plus the COP26 in Glasgow later in the year, particularly on the push to net zero. Mark Carney representing the UN and the British government on sustainable finance is a tremendous momentum behind the sector, particularly in fund management, which is really important, which is going to obviously invest in sustainable projects, label funds as ESG, environment, social and governance funds, for sale to both wholesale and retail investors. So we're very optimistic that the UK and the city is leading the world in terms of sustainable finance too, and that's supported, of course, by the government's own efforts on net zero. A particular challenge, then you ask about global regulation. So all of these things are increasingly globally regulated. We should have said that perhaps earlier on. Our sector, unusually compared to other sectors, we have very detailed international rules for banking, for insurance, for securities trading, and there will be also quite detailed international standards for sustainable finance, in particular the disclosure, things like carbon disclosure, use of carbon by corporates, disclosure by our own sector of what's in their funds, that they're selling you and me a sustainable investment pension product or something like that. So these standards and these labels become extremely important, and they are being worked on globally, and we are very influential on things that Philip said, very important. We are very influential in the G7, G20, the what's called the Financial Stability Board in Switzerland, which Mark Carney was the chairman of. So we are very influential, and we hope that we will be able to maintain a leading center, if you like, where these rules are obviously going to be laid down by the Americans or the Chinese or the Europeans or the British, but we hope that they will at least be aligned and interoperable. So I think we're very positive about that. And I should also put in a plug for the Green Finance Institute, which was set up by us and the government a couple of years ago to try and lead the world's thinking on how you encourage our sector to facilitate the move to net zero.
Thank you very much.
Thank you. Jeff, I think you're back on, are you?
Thank you very much, Peter.
Yes.
My apologies. Somebody obviously gave Horlicks to the donkey. The reality of sustainable finance, particularly at the sharp end of industry, where we are in hard to abate sectors, the need for investment is clear. Emma, you talked about consultation with industry. I wonder, is there any particular comments you'd like to make regarding our new trading relationship with Europe, about the barriers that UK companies have got to finance, including for sustainable economy developments and evolutions?
I will, but if I could just say a quick word about fintech, because I mean, Nick covered it very comprehensively, but just to mention that when the Chancellor spoke about financial services in Parliament on the 9th of November last year, when he talked about granting equivalence to the EU, but also he talked about the growth sectors for the future. And the two that he alighted on were green and sustainable finance and also fintech. And just to say, the industry, as Nick has already said, very much welcomed the Khalifa review. And one of the recommendations, I mean, the government is looking at all of them and has warmly welcomed them, but one of them I think is critically important, is this fast track tech visa for bringing in highly skilled people to come into the UK to help these fintechs scale up. So I think it's just an important element to talk about. On your second question, I don't see that there's a great deal of difficulty in that, because frankly, London and the UK has kind of been the financial centre for Europe, not the other way round. So a lot of sources of these finance, for sustainable finance and others, will come either from the UK itself or will be able to be accessed from other markets. So it's not a particular concern that we have.
Emma, thank you very much. William, I just wondered, to finish off my set, in your opinion, would diverging standards help or hinder the ambition that we're now talking about? Sorry, you're on mute. I beg your pardon.
Yeah, in an ideal world, it would be lovely to have one global standard implemented in the same way in every region and in every country, but that's not the world in which we live. In sustainable finance, I think there is a fascinating experiment about to take place. We have effectively two large, potentially competing blocks, the EU and the US, in terms of trying to set global standards for ESG and sustainable finance. Philosophically, the US and the EU approach this challenge from a different perspective. The EU is arguably more prescriptive based on a sort of definition of what it is as a means to encourage it, and the US is more market orientated. And I think there is an opportunity / challenge for the UK as to which of these blocks it ends up aligning more closely with. If it supports the EU's approach, then there is perhaps a higher chance of the EU becoming the de facto global standard. If, however, as a free agent, a significant free agent post-Brexit, the UK lends more of its political support to the US approach, then the US standard becomes the de facto global standard. And I can see that playing out in a number of other sectors where the UK and the US between them utterly dominate international banking and finance. And there is an opportunity and a challenge at the same time for the UK to decide how and where or with whom to align itself in this global debate.
Very helpful. Thank you very much. Thank you, Chair. Much appreciated for your patience. Sorry, Chair, you're on mute.
Sorry, I'm on mute as well. Yeah, sorry. Thank you very much, Chair. I'd like to turn to Roger Gale, please.
Thanks very much. Nick and William have touched on the global standards up to a point of quite considerable length. But Philip, what I'd like to know is to what extent are the financial services regulations global as distinct from between individual countries?
Well, first of all, financial regulation is a matter of the sovereignty of individual countries. And so there's quite a low amount of harmonization. The EU is a harmonized region, and the other main force of harmonization comes from the Basel regulations in Switzerland, mainly to do with the very important sector of setting how much capital banks have to have, how much money, easy money they have if there is a crisis, and bank insolvencies and things like that. Really, the heartbeat of financial regulation is set by Basel, and pretty well we all have to more or less go along with what Basel says. Now, otherwise, I think there's absolutely no doubt that around the world, financial service, the barriers to doing financial services around the world are very considerable. That's for all the usual reasons: protection of local business, local money, local consumers, the risk factors, stability factors, the fear, that foreigners are always scam artists. It's always the foreigners are wicked and we are the good people, the innocent people. And that's somehow very deeply embedded in humankind's psyche in the world at the moment, I'm afraid. But there is another very important point, and that is the administrative sanctions imposed by regulatory authorities are never enforceable abroad. So there's no way that one country can enforce its own regulation against foreigners. That's a legal matter because they're viewed as criminal. So for all of those reasons, the barriers are huge. You can't set up a local business. You can't get to take deposits from local people because you're taking away the savings of the people, which should be for the domestic economy, and so on and so on. Exchange controls. I mean, it really is a ferocious and extremely complicated, impenetrable thicket. It's completely out of control, so far as I can see. But there is one glimmer, and that is that in the region of the wholesale market, that's big institutions, dealing with big institutions, it's pretty free. You can buy and exchange, you can buy and sell foreign exchange, you can send out prospectuses raising capital, you can do loan syndications all over the world without, generally speaking, without the hindrance of local regulation, provided you only deal with sophisticated investors. So I think that's an important development. But on the whole, I think the world situation is still not very good.
Thanks very much. That's very interesting indeed. Now, if I can move on, and perhaps, William, you could have a crack at this. Those of us who are not involved in financial services tend to think of financial services being big banks, big bucks, big companies, and big international business. But one of the things that's been of a lot of concern to us all on the panel has been the effect on small businesses. And I wonder if one of you, possibly William, possibly Philip, could indicate how much these differing regulations from country to country to country, and then from bloc to bloc, United States, European Union, how much those impact and are a barrier upon trade for the smaller businesses.
It's a very good question. If I could hazard a stab at an answer. The larger the firm, the larger its government affairs, legal compliance department, whose day job is to deal with these differences and help overcome them. Indeed, lobby governments and regulators directly to smooth off the rough edges. And obviously, the smaller the firm, the less capability that they have. We've certainly seen in some of our work over the last few years a number of smaller firms that don't have this in-house capacity deciding to reduce their activities, in one or two cases to cease their activities altogether in the EU, because it simply wasn't worth their while. They didn't have the capacity to deal with the problem. But in many cases, these firms had a relatively limited business or footprint in the EU. And I'm not sure about the causation and correlation. I'm not sure if they had a small footprint because they were a small business, or they were a small business because they had a small footprint in the EU. But certainly the complexity that Philip talked about of different financial regulations at a global, regional, and national level doesn't help, and it has a higher impact, perhaps a barrier to growth for smaller businesses.
Do you know, does anybody know if there is an organization that is providing serious backup for those smaller businesses. I understand exactly that you've got the scale of a big company, they've got the in-house capacity to deal with all this stuff, tedious though it may be. But it clearly is a barrier to smaller companies. Is there anybody providing that service saying, yeah, okay, fine, we can do this for you?
There are some third-party providers. So, for example, a number of firms that we've identified as having relocated some of their activity to Luxembourg post-Brexit, they're actually channeling that. They're channeling that activity through a Luxembourg company that operates as a sort of a third-party host, if you will. It is offering to take on the administrative capacity and the administrative burden of looking after that firm operating in the EU. I'm not aware of that happening on a wider scale. I'm also not aware, perhaps Emma and Nick might be more aware of any sort of support mechanisms available through trade associations and government.
Emma, do you know? You've just been asked.
I don't know, and there are small businesses in our membership, but it's true to say in finance that because of the reasons that William has just set out, it does tend to be dominated by, bigger banks, bigger asset managers. These things, kind of lend themselves to that scale. So I don't really have a good answer for you. We certainly don't. We are a representative body that seeks to make sure that the policy environment is as good as possible. We do not give the sort of support that you're talking about, Roger, and I'm not sure whether other trade associations that are more specific to specific sectors do so either, but I could check and certainly come back to you if that would be helpful.
It'd be really useful to know. I'm happy with that, unless Nick, you want to add anything, but I'm happy with that answer. If you could let us know, that'd be really
nothing to add to that.
Happy to come back to you on that.
Thank you. That's great.
Thank you very much, Roger. Hilary, can I move to you, please?
Thank you very much. Indeed, can I just go back to Caroline Lucas's question and put this to you, Nick and others? I mean, from the press reporting about those banks which have said we won't be able to provide a bank account for UK citizens living in the EU, what's striking, some have said there won't be a problem, some have said there will be, but in certain countries. And they announced in this place, this country, this country, this country, we won't be able to provide the service anymore. And that prompts me to ask you, to what extent is what the sector can continue to do dependent on the different regulatory regimes in different member states? Because we've talked a lot about the overall agreement and the loss of passporting, but it is quite clear that there are different degrees of regulation. And for those banks to have said, we're stopping accounts in these countries, but not others, suggests that the local regulation is actually more significant here. Can you comment on that? Nick?
I'm not, yes, Hilary, I'm not an expert on retail banking regulation. I mean, as Philip might want to comment, but if you're, I mean, deposit taking is a regulated activity, and it's now set out in European, in EU legislation. So most of the things that we're talking about today are regulated activity, and therefore you cannot do, as a rule of thumb, you cannot do them cross-border. So the investment banker in London, in some cases, cannot even talk to the client in Italy or wherever it is, because that conversation is giving investment advice on their structuring a bond or something counts as a regulated activity. There are some national, the reason I'm being a bit cautious, Hilary, is there are some national exemptions for dealing with third countries. And in particular, they tend to be in the wholesale space where you can continue to do business with somebody that you already know, crudely speaking. But I think most regulatory players would probably advise you against building a business model on that. And I think in the case of some of these retail questions, I think maybe some jurisdictions have kind of said, well, if you were already doing it, it's okay. You're not entering into what's called financial promotion. I'm not trying to get you, Hilary, as I'm not a German bank trying to get you as a new customer, or vice versa if you're in Germany. And so in some cases, people continue. But on the whole, you can't do regulated activity between the EU and the UK.
Okay, but to take an example, if say a German engineering firm has a business interruption insurance policy with a British insurer, can the British insurer pay out?
Well, so that's a good example of a regulated activity. So that business will. So what has happened all of last year is all of that kind of activity was repapered, to use the kind of term that the sector uses, to an EU entity.
Fine.
So the insurance, so almost certainly that insurance, well, best practice would have been for that insurance contract to have been repapered to the European arm of that company. So what you saw last year was in hundreds of millions of euros spent by the sector in essentially splitting their Europe-wide business into UK business and EU business, and making sure that their clients were assigned to the right entity, as it were. And of course, in the case of insurance companies and banks, that means the capital backing that has to be moved to the EU entity, if it was a new EU entity, or you beefed up your EU entity. There was a slight exception the other way around, because the UK has actually granted, if you like, an exemption for inward business for a temporary permissions regime. So if you like, if the reverse were true, the company would still be insured by let's say the German provider for the time being under a temporary license. But the end state in a couple of years' time, even in the UK, will be you can't do that kind of activity without a UK license.
Okay.
So it could be a subsidiary of the German insurance company, if you like, or indeed a branch of an insurance company. But you have to be so the answer to the fundamental question is we split. Is an act of deliberate fragmentation, if you like, and deliberate cost to split the business in two.
Okay, that is really helpful. Emma, can I turn to you? You said in answer to an earlier question that there'd been so much preparation that the transition after the end of the transition period has been quite smooth. Do we yet know what difference, if any, there has been in the total amount of financial services trade with the EU so far this year compared to last year? There have been some sectors that have done less business, some more, because we've obviously seen the trade figures, but can you or any of our other witnesses give us just a sense of what's happened so far?
Well, one of the key things, this may not answer your question, so I'll come back, but one of the key things that did happen on, I think it was the 4th of January when markets open, because the EU didn't grant the UK equivalents in derivatives trading and shares trading, though if you were an EU entity that wanted to trade those, you couldn't trade those out of London. So we saw euro-denominated share trading largely move to Amsterdam. You may have seen some headlines about that, and derivatives more probably equally split. We don't know the exact figures between New York and other places. In terms of trade flows, it's a little early in terms of exports. We think that the proportion, I haven't got the figures at hand, but the proportion, so we used to export a high proportion of financial services exports to the EU. That has certainly decreased and will continue to because of these new rules and regulations.
Right. That's over. Does anyone else want to briefly supplement that? I've got just one other very quick question.
Okay, Lewis, just to say,
yeah, Nick.
So it's important, I think, for the context and what we discussed earlier about the wider relationship. The EU, almost uniquely in the world, was very dependent on London for its wholesale market activity in euro. So shares are perhaps not such a good example because French shares are generally traded on the French exchange, as it were. But London had a huge share of the international capital markets, in particular, as Philip said earlier, foreign exchange, I would say commodities, and derivatives, fixed income derivatives, for example, hedging your mortgages and things like that. Now they want to onshore what they regard as important markets in euro. So that's why, as Emma just said, they didn't allow European EU euro-denominated shares to be traded on the London platform, despite the fact that London platforms are regulated exactly the same way. They are equivalent, to use that word, of course. Indeed, we would probably argue better supervised and regulated than many EU markets are. And therefore, there was a challenge because of that business to be repatriated. And that isn't going to change. So you have fragmented that market. Remember, you may remember they did that with the Swiss shares a while ago, and said, the Swiss platforms couldn't trade European shares, and the Swiss retaliated, and so the business was split. I mean, we hope the UK, by the way, won't adopt that kind of approach. But that's what you've seen on exactly as Emma said, on the 4th of January.
Okay, all right. That is helpful. I just want to put one other final, very quick question. The Lugano Convention, which the EU's negotiated with a number of other non-EU countries, which deals with which national courts have jurisdiction in cross-border civil or commercial disputes. The UK government said we'd like to join, and the EU is recommended to member states that the UK not be allowed to join. Is that something that you are concerned about, any of you?
Yes.
Yes, we are.
Oh, you are, right, okay.
Yeah.
I mentioned it at the top. Yeah, absolutely. We have been, we're in touch with the UK government and stressed how important this is in terms of enforceability. So it's important for those businesses that have those cross-border contracts that you should be able to, there should be this, enforceability. And to be quite frank, we think this is fairly political. We don't know why this should be the case, that we shouldn't be able to join. It's not just, as I understand it, EU member states, it's the EEA. The Commission, as you have said, has advised the Council not to allow us to join. There don't seem to be any particularly objective reasons for that, and now it's with the Council.
Okay.
Council of Ministers.
Well, that's something to pursue. Thank you very much indeed.
Thank you, Hilary. I'm now actually going to put the next question on behalf of Stephen Farry, who's having to give a statement in the House this morning and therefore isn't with us. Could I ask, is it at all likely that as a non-member, we will be able to restore access as it was to the EU markets? Could I start with William?
In the interest of expectation management, I think the short answer is no. Most of the access was a mechanical consequence, a mechanical benefit of being part of the single market in the EU. Once we have decided not only to leave the EU, but to leave the single market and the jurisdiction of the ECJ and end freedom of movement, just at a mechanical level, that access cannot be, we cannot have the same level of access. We may, in the next few years, regain a small amount of access in some sectors. But my instinct from talking to people across the EU is their thinking is, well, why would we? Their perspective is that they have successfully repatriated a degree of activity that in many cases they were never entirely happy with the fact that it had relocated to London under the single market over the previous 20 years. So why should, having successfully repatriated, regained this activity, why would they let it flow back to London again in future? So I think the safest working assumption for the industry is that while the EU may grant some limited additional equivalence in future, it will not grant any substantial additional access to EU markets and customers for firms from London.
So
hopefully
start
they will.
But Nick, would you like to? Sorry, William. I was going to say, Nick, would you like to add anything to that, or to take?
William, I totally agree with William. I mean, seen from the Brussels or the maybe the Paris perspective, is a better way of putting it. They want to build up their own onshore capacity, and they were heavily dependent. They still are heavily dependent, I suppose, on capital market services from the UK. And so I think William is right. And in a way, Brexit is goes with the grain of what they were trying to do with a single market agenda on capital markets anyway, which is to build up capital markets activity in Europe. And they will, senior officials in the Commission will openly say, we were very heavily dependent, 90% plus, you hear people use that statistic, on the UK, and now we've got to build it ourselves. So I think William is right. They will try and build up onshore capacity. There are one or two gaps there, though, is where it is, let's say, in the EU's interest to access international markets through London, which they're not going to move to the EU. And I'm thinking of things like commodity markets or foreign exchange markets, let's say, perhaps more broadly derivative markets. Then what do? So I think William's right. You keep open a window of perhaps they will allow some form of of access in future. But I think for the time being, it's pretty clear that access has gone.
Thank you. Emma or Philip, do you have anything to add?
No, I would agree. I think the big question is, have we hit rock bottom? Or or are there further restrictions? Our member firms are not optimistic about further equivalences being granted, and we've got a question about this coming up. But if the EU's objective was to tie us in and make sure our regulations were aligned with theirs, they should have granted us equivalence. And then if we had diverged, we then withdrawn equivalence, which you can do at 30 days notice. That's not their objective. Their objective is a sort of location versus efficiency agenda, which is locate as many jobs as you can and these capital markets within the EU. But there could well be implications of that fragmentation. Caroline asked about fragmentation earlier with regard to, British people living in the EU, but there could be costs of fragmenting that supply of capital and the services that London provides to EU businesses who rely on those products and services. I.e., they could become more expensive.
Yes. Thank you. Well, that's a very good segue into the next question. Professor Winters.
Yeah, thank you, Peter. I've got the sort of complementary question to that. I understand that you believe that the EU is going to offer nothing, but are there things where London would be, the industry, the city financial sector, services sector, would be willing to contemplate aligning with EU regulations for the sake of an improvement in trading conditions? Or is it the case, as I think I inferred a year or two ago, that we so value our independence as a regulator that frankly we wouldn't be willing to compromise and be regulation takers at all?
In answer to that, where to start really? You could talk all day about equivalence and market access. They're not necessary. So the first thing to say about equivalence is many of the equivalence provisions actually don't regard market access. Some do, and many don't. Given that the EU hasn't granted equivalence beyond two very specific areas, I don't see really the point in the UK cleaving to exactly what the EU is going to do. There isn't that much advantage in that. I think the advantage to the UK of now being outside the EU is that regulators and the government have that agility, particularly in those new and emerging areas that we've talked about, whether it's fintech, green finance, data, to tailor regulation to the UK's market. But I put a caveat around that in that, global coherence, global standards are important and convenient to global business. And I would say this is not about a race to the bottom. And Nick and I do a whole engagement program with EU interlocutors, other trade associations, member state governments, etc. And we're always at pains to say, for us, what's happening now is not about a race to the bottom in standards. We regard the UK's high standards, coupled with, crucially, the openness of the UK market as a significant competitive advantage and a way to attract business here. So just to say, this is not a deregulatory agenda, certainly not on behalf of the industry.
Okay, thank you very much. Does anybody else want to add very briefly to that? No. William.
If I say very briefly, one of the lines that we use, equivalence is another word for trust. Right now, that trust simply doesn't exist because of the politicization and the tone of debate during the negotiation period. There is, as Emma said, almost every EU regulator, policymaker, politician that we have spoken to over the past 5 years is utterly convinced that the UK wants to deregulate, wind back the clock, and steal business from the EU. And I'm simplifying, but I think that's their broad assumption. And until that gap can be closed, until trust can be built up through the mechanism of the MOU, through perhaps a dialing down of the tone and language in the debate, then I don't think it's even material as to whether the UK would be prepared to consider alignment, because equivalence is not on offer.
Okay, thanks. I think that confirms what I thought the situation was. Could I switch direction and ask a couple of quick questions about jobs? I mean, first of all, I think the estimates are a little over 7,000 jobs have got up and left the city for European destinations, European centres so far. What do you have any feeling for what that number might be in 5 years' time?
Can I jump in on that? We recently published a research which came up with a very similar number, 7,400. We think that's an underestimate. We think the real number at this stage is closer to 10,000. And that is, to be clear, very much in line with the Bank of England's forecast for what the number of job relocations would be on day one of Brexit. What will be the number in 5 years? I don't know. The one thing I think we do know is that it will be higher. We know that the number at the end of this year, the end of 2021, is going to be higher than that, because a lot of firms have already agreed to move capital, jobs to their entities in the EU over a defined period of time. They just haven't moved them yet, but they've agreed that with European regulators. So we know the number will be higher in a year's time, and I'm almost certain the number will be higher in 5 years' time. What I think we also know, there was an unfortunate number that was thrown around shortly after the referendum of 232,000 jobs moving. That assumed that literally everyone who works in wholesale banking and finance in the city would have to up sticks and move to the EU. We know it's not going to be of that magnitude. Yeah. For what it's worth, our working estimate at New Financial is that over a 5 year time period from actually leaving, we could be talking around something like 30 to 35,000 jobs. That's roughly 10% of what we might call the city.
Can I just add, what's interesting though is that if you look at the most recent financial services jobs figures, and admittedly they go up to 2019, the ones I've got in front of me, the employment in financial services as a sector has remained broadly stable at just shy of 1.1 million.
Yeah.
Worth bearing in mind.
Okay, thank you very much. So finally, another is a related question, but the other end of the telescope. Emma has told us that half of financial services exports originate elsewhere than in the City of London. I'm interested to know, to what extent do financial services sectors elsewhere in the country depend on the arrangements struck with the EU? In other words, do we expect that the rest of the country is completely immune because it's just domestic, or is it the case that we expect some of these frictions that we're talking about actually to come back to reside outside London?
I'm very happy to. So a lot of that work is not strictly dependent on the rules and regulations and the nature of our relationship with the EU. However, I think one way of thinking about Brexit and its impact on financial services in the UK and on jobs is Brexit as the occasion or the catalyst for restructuring and rethinking firms' footprint and activity across Europe, rather than strictly the cause. That 7,000, 10,000 number that we mentioned earlier doesn't include thousands and thousands of jobs that have been created, particularly in countries like Poland, over the last 5 years in predominantly support and back office roles. Firms like RBS, Credit Suisse have moved significant numbers of people from their support functions in the UK elsewhere, not because of Brexit. They don't have to move these people because of the shift in our trading relationship. Brexit caused them to do the fundamental rethink of their footprint in a business that for the last few years has already been pretty challenged from an economic perspective. So I think one way, Emma makes an excellent point that we must view these jobs in terms of total employment in financial services. We must also view any longer term impact of Brexit on jobs in terms of this sort of wider Brexit as the occasion, not necessarily the cause. There are jobs in Bournemouth, Manchester, Glasgow, Belfast that could find themselves at risk of being moved to Estonia, Poland, Lisbon, not because of the regulation, but because firms have had to rethink their whole business model as a result of Brexit.
But can I just add to this? I think we're going to get onto this, but the missing piece of the picture in all of this is that we're just talking about Europe, and Europe is really important, okay? But the rest of the world is important too. So I don't think we can see the future success of the financial services sector in London and across the country just through an EU lens. And actually, you know, obviously the argument for Brexit that was made was that we would have more flexibility and agility to pursue markets across the world. And that's what the government now needs to deliver on. And, you know, we're looking at the US, Switzerland, they're looking at a mutual recognition agreement with Switzerland, which would be excellent. It's not just about free trade agreements. As Nick said, they tend to focus on goods, although the recent one with Japan was very promising in terms of the focus that it had on services, and we were pleased with the provisions in there. So I know that this commission is looking more broadly, so I think it's worth just putting that point on the table.
Okay, thank you. Okay, that sounds like a catalyst to move forward. So back to you, Peter.
Thank you very much. And indeed, that was a fair point to make. I'm actually going to change the order of the questions here because Professor West has a hard stop. So, Joe, would you like to take yours now?
Thank you very much. And it's been a really interesting session, and I appreciate everyone being so open with their thinking about this. This is following on a bit from points that have already been made, but Emma, I think you mentioned earlier on and at the very beginning of this, different parts of the UK and the impact of, I think you said 2/3 of those employed in financial services were outside of London. I just wonder, and it may be too early to tell, how are the relocation of these jobs and assets being felt, and what you think the direction of travel is, or the impact of a lot of the changes that we've just heard about on not just London, but on different parts of the UK. I think the point that William just made about really almost Brexit as an excuse to restructure was very interesting. And I'm just thinking about not just London, but particularly with the government's levelling up agenda, the different parts of the country as well.
Well, from what we see and from our members, there are thriving sort of regional hubs across the country, and by the way, in the devolved nations. So, there's additional, a number of our firms are making an additional investment into Scotland, for example. Barclays is opening new offices in Glasgow. So we are not really seeing a sort of bleak picture, if you like, if that's the question, across the UK in terms of jobs. On the contrary, and the 2/3 figure is really for that wider ecosystem, the 2.3 million of financial and related professional services jobs. So as I said, broadly, the employment figures for financial services are just shy of 1.1 million. On assets, I think assets are slightly different and more complicated, and according to the EY Brexit tracker, firms have declared 1.3 trillion pounds worth in assets to be transferred to the EU. Now, we don't know exactly how that would work out in terms of tax and economic activity, but obviously assets are linked to those things, so could have detrimental impacts on those. But I think, William, you did a bit of work on this too. You might want to come in on that.
Firstly, just to add a little bit of context to my comments earlier about the outlook on jobs. It's very easy in this debate to become very pessimistic very quickly, because 10,000 jobs, when people start saying, oh, it's only 10,000 jobs, I think that's not the way we should be thinking about it at all. That's 10,000 individuals and their families' livelihoods. But it's very important to focus on the wider picture, the wider the number of jobs in this industry in the UK, and it's clear that there has not been a wholesale shift in jobs and activity to the to the EU. We can't. I don't think anybody's under any illusion that we're at steady state, But where we are right now is roughly, I think, where most people thought we would be. It's not a Ramona argument to say that this is bad news. It's equally not a Brexiteer argument to say that it's less than some of the worst projections. The issue of assets, one of the things we do, we tried to isolate in our research banking assets. And what we found was £900 billion of bank assets are being moved or have been moved from the UK to the EU. That's obviously a very big number. To try and put that in context, it's 10% of the entire UK banking system. Or 10% of bank assets in the UK, rather. So international and UK bank assets in the UK. 10% of that is going or has already gone. We can add to that another 125 or so billion, because a couple of weeks ago, JP Morgan announced that it's moving up to another $200 billion to the EU. JP Morgan did not wake up last Tuesday and think, we've already moved $220 billion. I tell you what, let's move another 200 next week. This is part of what I mentioned earlier. They have agreed already with EU regulators that this activity, these assets, these staff will be moved as part of their authorization. If you run that through the long-term impact, if you think headline number, banking and finance generates roughly 11% of UK tax receipts. Let's imagine that there is a linear relationship between assets moving and profits generated. It's probably not linear, but let's imagine that it is. Then what you've got is 10% of 11% of tax receipts moving from the UK to the EU. So we're talking about roughly 1 percentage point, 1% of UK tax receipts as the direct economic impact. Now, it won't be as neat as that, but I think that's roughly the ballpark in which we're heading.
Thank you very much. I think I'll pass back to the chair now.
Sorry, mute again. Thank you very much, Chair. Paul, can I turn to you, please?
Yes, thanks. And it's kind of a natural next step from the discussion we're having, I think. If we kind of reflect back to the point at which we decided as a country to leave and the government drew the red lines about the single market, there was a lot of speculation about the opportunities that might present for the ambitions of Paris, or how Frankfurt might be advantaged. It kind of feels like the consensus is that the risk isn't to London isn't primarily from European centres, and I welcome your kind of confirmation or disagreement with that. But what about the non-European financial centres, and where is the New York and Singapore we've talked about, but where is the competition? What does the terrain look like going forward? And William, perhaps you could start.
Well, so I'm assuming everybody can stay on till about 5:30. Is that okay? That is a huge topic. But so to break it down, firstly, yes, Paul, I think you're right. No single EU financial centre was ever going to challenge London as an international financial centre. And I think it was always a bit of a straw man argument before the referendum and since for anybody to claim that it would. What we have seen is over 400 firms have moved something to the EU in response to Brexit to ensure continuity of access. And we've seen that those relocations have been distributed across 5 or 6 financial centres. They've not just gone to Frankfurt or all gone to Paris. It's a mix, and they've tended to relocate in line with their sector. So asset management firms have tended to relocate whatever they've needed to Dublin. Banks have tended to move to Frankfurt and so on. And I'd be very happy to share the research that we did with this offline with all of you. those firms are competing with London to the extent that there is certain EU-related business that used to be done in London that now no longer can be done in London. It is that mechanical. They are not competing with London for the rest of world international global business that was previously done in London. And I think it's a really important distinction. And the rest of world business, from London's perspective, is more important, bigger than the EU business ever was. So London's competitors as an international financial center, a global financial center, are predominantly New York on the one hand, and a mix of Singapore and Hong Kong on the other. Those are the only realistic competitors in any sense. And at the margin, a small amount of business will relocate, has relocated to the US. As a result of Brexit, we've seen a shift in some derivatives trading. Again, it's mechanical. It cannot be done on a trading venue that is not recognized by the EU. There are trading venues in the US that are recognized by the EU. This is a global business. At the press of a button, that business is relocated and done through New York. But it is very much at the margin. So I'll shut up in a minute, I promise. Just give one example. A few years ago, we spoke with the global head of markets at a big US investment bank that has chosen to headquarter its global headquarters for the vast majority of its trading businesses are in London. And there's a reason for that, which is that they experimented running global businesses from New York. It doesn't work because of time zone. They experimented running global businesses from Singapore, from Hong Kong. It doesn't work because of time zone. So if we add that back onto all of the reasons that Philip outlined earlier as to the basis of London's position as a dominant international financial center, that isn't going to change because of Brexit. Firms are here because it works for them, and they concentrate their activities here because they choose to. The stuff that moves as a result of Brexit is stuff that has to move because of regulatory change, but it is a relatively small percentage of the total volume of activity that is done through London.
So thanks for that. That's very helpful. But summing it up, you're saying that there are no ways in which London's position has been damaged beyond the specifics from our departure and the nature of that departure.
It's certainly been damaged, but the point I'm trying to make is trying to be a little more optimistic than I have often been over the past 5 years. Not hopefully being Pollyannish, but there is a definite mechanical impact. London has been damaged. We would characterize that damage more as a sense of sort of bruising or a fracture or breaking an arm. This is not terminal. The UK was a very significant global financial center before the emergence of the single market in financial services in the EU. That position was concentrated by the creation of the single market in financial services in the EU over the past few decades, but it was not entirely dependent on it. And what we're seeing is rewinding the clock 20, 25 years in terms of the distribution of activity in Europe between London and other financial centers. If you rewind to the mid-90s, London was by far and away the biggest financial center in Europe, and as it still is today, the second largest financial center in the world. So we're rewinding to where we were 20, 25 years ago, perhaps, but it's not terminal.
Okay. Do you just following on that, in terms of when we talk about major financial centers, do you think that the terrain is going to remain similar, or we are going to become kind of less dependent on major global hubs?
It's a really, really interesting question. You might expect, given that we are hosting this meeting, I assume we're sort of dotted all over the country. We don't all have to be sitting in London anymore to be doing business. You might expect, therefore, that in a sort of post-COVID, post-Brexit world, you would see this dispersion effect in financial centers. But actually, over the past 20 to 30 years, despite all of the progress in technology, in the banking technology more broadly and the application of technology in banking and finance, we've actually seen a greater concentration of activity in financial centers. So I don't see a sort of dispersion. The individual might be sitting a 1 hour train journey from their office in London, but London will be where the activity is legally based, authorized, where the tax benefit accrues and so on, the economic activity takes place. I think we will see that continue to be concentrated post-Brexit, post-COVID, not dispersed.
Many thanks. I'm afraid, Chair, I've lost track of time. I don't know whether I've got the opportunity to ask other panelists if they've got any additional points.
Well, very briefly.
Well, simply that. Are there any points anybody would like to add to William's?
I'm okay. I completely agree with what William said.
I would just add, and what William said was brilliant. I would just add, look at the predictions for economic growth around the world, both in terms of demography and size of markets, and it's quite a revelation. You know, Europe shrinks, so the growth is going to come obviously from China, from South Asia, and potentially from Africa too, as you get an emerging, you know, middle class with pension fund assets to invest. And London, hopefully, remains the major international centre in helping channel those funds. As I said at the beginning, it's all about intermediation. So William's right in the sense that the loss of the EU, if you like, or the fragmentation of the EU business that was done here is a lose-lose, right? Costs rise and nobody particularly wins from that. But London can stay as a major international centre. I thought Christian Collier, who was the former chairman of the CFTC, which I think was in his resignation speech in London, talked about mean reversion. And I think that's exactly, William, what you were just saying. You go back to being much more of a major international centre than an EU centre. The irony, of course, we used the single market to great effect since the 1990s to centralise more and more in London, and that has now ended. And the point about the hubs, I think we in the city are confident there will be a return to the city, there will be a hub effect, but it goes back to what we were saying earlier, that actually there's a secular trend going on in terms of looking at costs and operational centres, and you may well end up with, you know, trading floors. I think the big investment banks are very clear. They want trading floors together, largely for compliance and cultural reasons, but you could have some of the support functions can be outsourced. So I think you're seeing that in the UK and possibly even globally. And the only thing that could stop that would be, I guess, regulators just saying, well, enough is enough. You can't outsource too much. And that may be a threat, by the way, in the future from the EU to say we don't want outsourcing to your operational centres from the European operations. But broadly speaking, I think that the growth will be in the rest of the world.
I think that's a very good introduction to Andrew's question.
Thank you very much, and thank you also, each of the speakers for their sort of clear and punchy answers. Actually, I think all of us have been sort of well educated. Picking up on the earlier points, I mean, the London, financial services market is a world leader, and I think we've heard, a slow, a creeping loss of jobs as a result of Brexit. I think it was, there's been, in the words of William, a fracture, in the words of Nick, a lose-lose as a result of Brexit. How do we stop a deterioration in terms of our positioning? And are we at risk of losing our global leadership in this space? Emma.
Thank you. And this will be building on a lot of what's already been said, particularly by William and also earlier by Philip Wood. Our view is that we're confident but not complacent about our competitiveness. And I think there's two things going on here. Firstly, we have underlying strengths that Philip set out very, very eloquently earlier, but they're really important. So the time zone is incredibly important. English as the international language of business, English law, the ecosystem that I've talked about repeatedly this morning, but that sort of supportive ecosystem of the professional services around the financial services that we've got in the UK. But we're not complacent because things don't stand still. So we are working very closely with the government to make sure we build on those underlying strengths. And how do we do that? We've got to make sure that we remain open And the government is very focused on that, and that's absolutely correct, because in order for us to remain attractive and competitive, the traditional view of the UK is that we've been very open to international business, etc. So that is really, really important. High standards are also important. And then we've got to look at not only ensuring that we've got a stable, predictable, welcoming business, tax, regulatory environment, but also that beyond the work that the Treasury traditionally does, the Home Office, DCMS, DIT, these are other departments that are really important to the future success of financial services. So international agreements with other markets to ensure that we open up those as much as possible. And then the final thing I'd say, and we've covered this again, is that we've got to be focused on the future areas of growth. And what are the future areas of growth? We've already covered them: fintech, green, data. It's pretty simple, really, put together. Underlying strengths, build on them, make sure that we're incredibly competitive going forward. I'm confident we can do that, but it won't happen automatically. I do think the government's made a huge amount of progress since November. They were sort of shackled by the Brexit negotiations, if you like, because they didn't want to talk about new policies going forward. And then in November, the Chancellor gave what was a very important, although very short, 10-minute speech outlining many of these things and launching many calls for evidence and around this. So we've since had the Hill review on listings, we've had the Collier review. All of this is creating a momentum, and we need to build on that and make sure that we don't take our competitiveness for granted and have a relentless focus on that. And that's got to be a cross-governmental effort working alongside regulators and industry. Sorry, I can't hear you.
Apologies about that. Sorry. Pick up on that, maybe for Philip. How does the government, actually help in terms of putting in place agreements? E.g., with the states or Asian markets. Tangible steps. I'm very interested in hearing how they can help.
Yes, I think the two things we can do, one, as a country. The first is we've got to press the case for free trade in world forums, in Basel, EOSCO, WTO, and especially the EU. We need to repair relations with the EU. The EU is founded on the principle of freedom, of trade. It's absolutely fundamental to their idea. And I think that idea, we need to persuade them that that applies worldwide, including to us. I don't think the present rancor and resentment has led to a degree of protectionism, which I'm sorry to see. It's a fact of life, but I do hope that the future will be brighter. I'm very confident for the future of London for all kinds of reasons. I also think that we ought to open the possibility of not just negotiating treaties, which take a long time, but having inter-regulator cooperation agreements which ease the path towards mutual recognition of each other's regulatory regimes. It is ridiculous to say that the UK has not got a strong regulatory regime, or that we're not equivalent, or that we're not up to it, or that we're sinking to the bottom. That really is ludicrous. Most of it, apart from the Americans, was designed by this country. So I think those points about the freedom and about the importance of regulation, provided it is properly streamlined, doesn't have too much red tape, and the promotion of mutual cooperation between regulations need to be pushed.
William? We lost William.
You're on mute.
I'm sorry.
We're on mute, yeah.
No, I would absolutely echo that. Firstly, to echo Emma's point, we need joined up thinking across government. We'll have a limited impact if we're talking about the city being the open crossroads for global international trade, if we are simultaneously, for various political reasons, applying at least the perception of a more closed approach to the rest of the world, whether that's tougher scrutiny on international takeovers, whether that's visa requirements, the immigration regime. So we do need more joined up thinking, so that what government actually says works, it flows all the way through the chain. To Philip's point, absolutely. I think the way forward here is not, and it would be an utter waste of time and resource, to start trying to negotiate financial services free trade agreements with countries around the world. The only example of a comprehensive financial services free trade agreement is the EU itself. And that's imperfect. And it's taken 30 years more since the beginning of the single market. And there's still a long way to go in financial services. So it's all about bilateral, closer partnerships, specific regulator to regulator discussion, negotiation to remove individual barriers and impediments to trade. They won't have a huge impact. We're not suddenly going to start having UK firms able to sell on passports into the US market and vice versa. We probably wouldn't want that. If you want to have a big impact on jobs in the city, do a full passport free trade agreement in financial services with the US, and a huge number of people would move straight back home to the US. So it's very much about individual bilateral, but we have to choose our allies, potential allies, and our potential battles very carefully. In international banking and finance, I don't think there's a huge value to taking on NASDAQ or New York's position as the global center for international tech IPOs. Work out what are the battles where we can win, what are the battles where we already have expertise and a strong track record, and build on them.
Thank you. Nick, and then Nick. Hi.
Yeah, well, I don't have a lot to add to that. I mean, I think if you're, that last point William makes is really important. You're not going to get hard access encoded in trade deals. And William said the EU is the only one to have done that. And that's because we did it, right? We drove the single market in services and financial services in the EU. They probably wouldn't have done it if we hadn't pushed them to do it. So you're back to the status quo ante, which is essentially setting up local establishments. But what you can do, and William's quite right, is you can have regulated cooperation agreements. The Japan deal is a good example of that. You can look at the adjacencies, things like work, mobility, getting your stuff, move in and out. Look at data. Obviously, as we discussed, we're a digital sector these days, so data flows becomes very important. And I think probably going forward, things like agreement on sustainability. So you're setting the context for what we would call deference, which is a sort of what the international regulators use that term, or mutual recognition. I think, Philip, you said that. And that would be done regulator to regulator. And the best example really is Switzerland, where we are very close, we think. I think Emma mentioned it earlier, in having some kind of mutual recognition agreement, or at least allowing our regulators to negotiate mutual recognition agreements under the rubric of a kind of a free trade deal.
Thank you very much, Chair.
Thank you very much, Andrew. And we've actually reached the appointed hour, but everybody, all our witnesses, are most grateful for you to be able to stay on. Let's set a new target of 12:15 to finish. Aidan, could I turn to you, please?
Thank you, Chair. Firstly to say that the witnesses have been absolutely wonderful. And one of the things that this has proved is that we need a bit of an education piece on this. I think there's been a lot of emphasis, and even in my own sort of sphere, on trade of goods rather than trade of services. And I think there is a need for a further education piece on this, and hopefully our interim report and our report will bring that out. I'm going to play devil's advocate for a moment, and I'm going to start with Nick, Emma, and then go to William. And I'm going to ask about the effects of what the UK is doing on possible financial services deals, and the fact that nothing that we do happens in a vacuum, and whatever political games are played do have ramifications. So my questions, and I'll roll them all together so you can answer them, is has the UK's threats to breach international law undermined trust with the EU and made it less likely that they will grant equivalence for the financial services sector? And how are those current tensions and lack of trust between the UK and EU, for example, over the Northern Ireland Protocol or over fishing rights, impacting on the prospects for a better market access in the EU for the financial services sector? And finally, is there a prospect of a fish for finance deal? So I'll start with you, Nick, please.
Okay. Well, look, the way I describe it, Aidan, we've just been through a rather traumatic divorce, right? And so levels of trust are low, and you know, as Emma said, between us we talk to a lot of people in Brussels and the member states, and you know, some of them tell us, well, you know, that's 10 years, right, to rebuild your relationship. I've not ever been divorced, so I don't know whether 10 years is realistic or not, but it sounds plausible. And yet in our sector, remember, as we mentioned earlier, we coexist day by day anyway, both in terms of actual financial activity. You know, major European firms are still doing a lot of international business in London or from London. You know, big fund managers are doing a lot of international activity from London. You know, so and they are also co-supervised. So our supervisors, our regulators are literally in daily contact. And the feedback we get on that is that relationship works very well. And the UK regulators, of course, have a very high reputation. And of course, they have a lot of expertise in the wholesale markets, which many of the European regulators are still drawing quite heavily on that. You know, as William explained earlier, there have been a lot of moves. Well, I can tell you, without mentioning names, some of the new regulators of entities which are in London are still very heavily dependent on talking to the Bank of England and the SCA for help in supervising them. So if you like, day to day at technocratic regulatory level, I think there is ongoing trust. But your question is, in a way, we don't operate in a vacuum, and I think that's absolutely true. So I don't think equivalence, as we hopefully explained earlier on, as Emma did, I don't think equivalence is particularly an issue, because we don't think there's going to be any equivalence granted by the EU. There's a question about the existing one, the clearing one, but I think that's more driven by their attempts to build up capacity than a political concern about the UK, or indeed a concern about the quality of regulation in the UK. But you make a very good point, which is that, you know, I don't think there's a fish for finance deal. It's too late anyway, right, for a fish for finance deal. But I do think that we do hear back about concerns about, you know, international law, rule of law, you know, Northern Ireland fishing or whatever. That political backdrop is always there. But we are confident that on financial services, they will be able to get that bilateral dialogue up and running. As I said, it kind of is anyway, right, under the radar. And that more importantly, going forward, the two sides will be able to talk as sort of independent sovereign regulators and parliaments about the challenges we face. And as we've all said many, many times to you today, those are, how do you deal with net zero and sustainable finance? How do you deal with the challenge of digitization? Probably things like cryptocurrencies and cyber threats and all these kind of things. That the two sides have very similar systems and need to talk to each other about how they're going to do that and cooperate internationally. And that's a really important point, again, was I think we've said repeatedly, most of what we do in our sector in terms of regulation is international. So that we sit next to the Europeans in everything from the G7 down to, you know, the network for greening the financial system in Paris, where all the central banks sit together and talk about sustainable finance. We literally sit at the table next to each other and talk to each other and cooperate. So I think in the medium term, we are quite confident. But you make a good point that, you know, it would be helpful if these international tensions were resolved.
Thank you, Nick. Emma, I want to tease this out a wee bit further with you. One of the things that Nick said that resonated with me as far as on a bureaucratic level, on a day-to-day level, this is almost as if it's business as usual for the moment. We know through the trade of goods that when it comes to an agreement, when it comes to furthering the relationship, it's got less to do with day-to-day bureaucracy and more to do with member states want and that sort of political dynamic that is there, and whether the Commission has a mandate from the member states to actually go that extra mile. And how do you see what's happening at the moment as far as the political tensions affecting the likelihood of us getting a closer financial services relationship?
Well, I broadly agree with Nick. I think the EU has an agenda anyway that we've talked about onshoring some of these jobs. And I'm not sure, even if the relationship were better, which we would obviously hope that it could normalise more quickly than a 10-year sort of time scale. But even if it were a very harmonious divorce. I haven't been divorced either, I'm glad to say. Even if it were, I'm not sure that we would be able to get any further equivalence or any further access to the market. But saying that, when Nick and I, and we see each other a lot, many times a week, with meeting with EU interlocutors, partners and others, these things come up. You know, as you say, we are not operating in a vacuum. The Northern Irish Protocol, the problems around that, the fishing issue, which is a big one, the row over vaccines, which seems to have abated, but none of this is helpful to the relationship. And I remember saying last year, you know, we really want a deal, even though the deal we know is going to be very, very thin for financial services and services more generally, but we don't want an acrimonious no deal situation. If we're not careful, we're ending up in an acrimonious deal situation. And obviously that is not, that is in nobody's interests. And just very briefly on what you said at the start of your questioning about exports and trade, you're absolutely right. And I was an MP for nearly 10 years, and I served in Hillary's exiting the EU Select Committee, and we didn't fall foul of this. But I think in Parliament there is a lot of focus on manufacturing when you talk about international trade and exporting. That's because it's really fun, if you're an MP, to go and visit that factory in your constituency that makes cars, because you can see it. And it goes back to Nick's earlier point about invisibility. It's not particularly exciting to go and visit a bank. I shouldn't say this, I'll get in trouble with my members. It's not as exciting for politicians. And therefore, I think services are a bit overlooked. So not just financial services, but I would make a plea. We make up services as a whole make up 80% of our economy and 70% of the EU's economy. So objectively, it looks very odd indeed that the agreement had very little in there for services and financial services between the EU and the UK, the TCA.
Thank you, Emma. That's very thorough. William, I'm going to bring you in last but least, but not least, I should say.
Thank you. First, I just want to draw what I think is an artificial distinction in the debate on regulation. Often you hear that this has been politicized. It should be a technical process. It's been politicized in the EU, or people in the EU saying that the UK are playing politics with regulation. All regulation is political. Any decision about regulation is political. So I think it's a sort of it's an artificial artificial distinction. To your points that yes, we've absolutely undermined trust. I said earlier, there is a deeply held view in the EU that the UK wants to diverge. They don't quite understand where the UK wants to go, what it wants to do, but they do think the UK wants to undercut them in some way. And that will take a long time, hopefully not 10 years, but it will take a long time to rebuild that trust. And while there has continued to be day-to-day, week-to-week contact at a sort of technical, supervisory, regulator-to-regulator level, that has also been impacted, let's not forget, by COVID. I was talking to the senior EU regulator the other day who was he was complaining that what he misses about his relationship with with UK supervisors and regulators is not just that we're not in the EU anymore, but it's the physical not bumping into them on the sidelines of conferences and after meetings and that chat over coffee. That's all gone. So the relationship is more difficult to rebuild in the current environment. On a more optimistic note, I think we're going to get to the point relatively soon, 3-5 years, where the EU says, okay, enough. This came up in a discussion, Nick was involved on this last week, that there isn't a single mastermind sitting in Brussels or Paris that is watching the number of jobs. And when it gets to a particular number of jobs relocated, it says, okay, we'll stop. Now let's talk, let's have a sensible discussion about a deal. But I do get the sense that the EU has it has in mind roughly how much activity it would like, in its view, to repatriate, roughly how much more domestic capacity it would like to build. And once it gets to that point, I think it will be satisfied that it sort of achieved the outcome from its perspective of the negotiations of Brexit, of the TCA, and then we can perhaps have a more grown-up, trust-based conversation in future. At least I hope so.
Very useful, and I liked your paraphrasing of the German novelist Thomas Mann. Everything is political. Chair, back to you.
Thank you very much, Aidan. Well, that's the end of the questions, save for one, which is I'd like to ask each witness for their single top recommendation for policy as we go into the next phase of developing our relationship with the EU on financial services. Emma, can I start with you?
How to choose? I'll get in trouble with my members. If I've got three, very briefly, we need further progress on the data adequacy position agreement, which is going in the right direction. We'd like progress on Lugano. We need to see what happens with mobility. Obviously, the UK decided to leave freedom of movement and not have freedom of movement, but we don't know what's going to happen, how that's going to impact short-term business travel, as I said earlier. And we'd still like to see the operationalisation of the MOU. So the MOU between the Treasury and DG FISMA coming together twice a year to talk about regulatory cooperation. Sorry, that's not one thing, that's several things.
That's okay, that's okay. Philip, what about you?
Well, if I could follow Emma, I've just got a very short points. First, I think the UK should tell the world that the UK is back with its brand. Secondly, I think we should continue to support freedom in the right of the people to put their money to work. The law should restrict us only in order to liberate us. The law is our servant, not our master. And lastly, we should look after one of the most precious assets of this country, placed at the service of the planet, and which no longer belongs to us, and which has been the product of many centuries of world. I don't refer to rugby or cricket. I refer to our laws.
Thank you, Philip. Nick.
Well, I agree with both Philip and Emma. I want to make one point, is specifically on the kind of follow-up to the TCA, is to try and get the user or the customer voice in there. And I don't think that was done very well by either side, actually. But, you know, because as we've discussed, there is a cost of the fragmentation, and let's expose that cost. So, for example, Lugano, Emma quite rightly mentioned Lugano, we very rarely hear, you know, the voice of the citizen on Lugano. So, you know, maybe the financial markets, as Philip knows very well, you know, operating under English law, choosing English law, maybe they're not quite so affected by that. But you hear, you know, citizens are, you know, in terms of, for example, using the divorce analogy or whatever, you know, you want your the real hits to citizens. There was the point about that Hilary was making earlier about, you know, retail bank accounts, things like that. And we hear it from big corporates, you know, German corporates complaining that, oh, you mean I won't be able to trade, you know, my aluminium in the London's metals market anymore, and things like that. Well, that kind of voice we need, that raise a bit more. And then really, as William was saying in his last comment, hopefully then we can get back to a more balanced discussion with the EU about where it's in their users, their citizens' benefit to get better access, and of course, vice versa.
Thank you, Nick. William, to you.
Or I would add as an example, the large Chinese international company that recently got in touch with us because they're conducting a review of European financial centres with a view to where they should best place, or whether they should keep their international treasury operation in London or move it. I would make a futile plea to make Brexit boring again, to particularly in financial services, to dial down the politics and start focusing on the technicalities, the nuts and bolts, to build on the MOU, first to get that MOU across the line, to build on it. As Emma said, inevitably EU regulation is going to change over time. It's going to evolve. Inevitably ours is going to as well. There is going to be divergence. We can all be grown up about that. And so long as the UK sits down and talks about where it wants to diverge or where it thinks it needs to diverge and what it means by divergence, the quicker we can rebuild trust with the EU, which still is unclear as to what it thinks the UK wants to do in future. And that is the fundamental barrier, in my view, to closer cooperation between the UK and EU in financial services in future.
Thank you very much. And the point you make about Brexit is a very good one. And of course, the work of the Commission is Brexit is only a historical fact, and we're looking only to the future and hopefully to come up with some positive recommendations for those involved in policy. I'd like to thank all of the witnesses very much indeed for their contribution today. It was extremely interesting on all fronts. I've learned a lot. I'm sure all the commissioners have learned something. And it's a very, very positive contribution to our overall work. So thank you very much indeed. And look forward to developing various of the topics we've discussed in follow-up in due course. Thank you all.
Thank you. Thank you very much.
Bye-bye.